Welcome, and thank you for joining us for today's call, part of our SLGI webinar series, which is a series of regular touch points with our portfolio management partners. This is our fourth call this summer featuring MFS. My name is Jim Benoit. I'm Regional Vice President for Eastern Canada at Sun Life Global Investments, and I'll be your host and moderator for today's call. Today, we're going to be hearing from Peter Longto, Director and Institutional Product Specialist at MFS Investment Management in Boston. MFS is an exclusive sub-advisor to SLGI. They sub-advise 16 of our mutual funds, both in trust and class versions, including the Sun Life MFS Global Growth Fund, US Growth Fund, International Value Fund, and today's feature fund, the Sun Life MFS International Opportunities Fund. For nearly a century, MFS has aligned their active investment approach and the way they serve clients with a sole purpose: to create long-term value responsibly. That commitment started in 1924 when MFS launched the first US open-ended mutual fund to give millions of everyday investors access to the markets. As of June 30th, 2020, MFS had global AUM of $509 billion US. Before Peter begins his presentation of the Sun Life MFS International Opportunities Fund, here's a little bit about his background. I mentioned already that Peter's a director and institutional product specialist at MFS, which means he provides insight on portfolio positioning and strategy and serves as a liaison with portfolio management for MFS's global, international, and emerging equity strategies. He joined MFS 13 years ago in 2007. His formal education took place at two excellent schools. He obtained his bachelor's degree from Boston College, and he holds an MBA from Cornell. Today, Peter's going to provide a market update. He's also going to give us an overview of the fund and why MFS believes that this fund is truly different from others in its category in terms of strategy. He's going to talk about the recent drivers of performance and how the fund is currently positioned, which of course is based on where the team sees opportunities given the current market environment. In terms of logistics for our call, Peter will speak for approximately 30 minutes, and then we will open it up for some Q&A. We've received some questions for Peter already, but you can also submit your questions through the Q&A box that you can see at the bottom of your screen. I'd like to now turn the virtual stage over to Pete Longto. Pete?
All right, thank you, Jim, and good afternoon to everybody. Thank you for calling in this afternoon to hear our thoughts on markets and how we're positioning the MFS International Opportunities Fund. And I will start on page 7 with just a quick look at how this bear market and then bull market compares with prior pretty dramatic market sell-offs that we've seen in the past. And with our current situation is represented by the green line on this slide. And this really, I think, puts into context the stunning speed, first of the pullback, how we dropped so precipitously in February and March. But I think what's even more remarkable has been the speed of the recovery. And you can see it's typically been 5 to 7 years for markets to recover from these significant sell-offs. But in this case, it's been just 5 months. And with the S&P 500, which is what we're showing here, is now back above its pre-crisis levels. Other markets around the world, some of them not quite all the way back, but for most of the major stock markets on a global basis, they are most of the way back, and it's just been incredibly fast. We think it's been fueled obviously by some optimism around development of vaccines and therapeutics to treat the coronavirus, but probably more so in response to the stimulus that policymakers have implemented. And as we move on to the next page, we certainly have been surprised at the speed of this recovery. And we do think on page 8 shows that we think there has been a bit of a disconnect between markets and what's going on in the economy. And this shows that the rebound started despite rising unemployment claims. We saw composite PMIs, which provide a directional measure of economic indicators in many markets around the world. At the time the stock market recovery began, those were still dropping very rapidly. We do still have a lot of people out of work. A lot of small businesses in particular have been destroyed and will not be coming back. And then many large businesses are going to take several years, we think, to get back to pre-crisis levels in terms of the revenues that they were earning. And on top of that, now we've added huge amounts of debt to the system. And on page 9, that gets into the policymakers' response to this crisis. And here we compare it to the response during the global financial crisis. And it really has been an unprecedented response. I think the lessons that policymakers and central banks learned from the global financial crisis were to be bold, be early, and use all tools at their disposal to try to support markets and risky assets. And these charts measure that in the current environment, and obviously comparing it to the GFC. I think at the macro level, as we think through the implications, this unprecedented level of monetary stimulus is likely to have an inflationary impact over the longer term. We certainly aren't seeing or expecting to see evidence of that in the near term. But with a long-term view, we do think that there's a reasonable expectation for higher inflation. And then just at the market level, this means extremely low yields on most fixed assets. And so that only makes equities even more attractive. And as we go on to page 10, in thinking about one of the real characteristics of this market recovery is that it certainly has been driven by a small group of tech companies. And so that has led to very significant valuation gaps. And this chart measures for both the S&P 500 and the MSCI EFA index the difference in valuation between the 75th percentile and the 25th percentile stocks in each of the indexes. And for the US, this spread is currently above levels seen over the last 20 years. And for EFA, this spread has been higher only twice during the last 20 years. That was during the global financial crisis and in the early 2000s during the tech bubble. So I think it's not entirely surprising, since during market dislocations, investors tend to seek safety in very quality and very stable stocks and away from the higher beta stocks. That's been the traditional market reaction. But in this environment, I think a unique feature of this has been that it hasn't been the real low beta, the real defensive stocks that have been rewarded. It's actually the stocks that were previously expensive heading into this crisis, the tech stocks. They just happen to be the ones with the business models that were perfectly suited to working from home and more e-commerce, everybody consuming most of their entertainment from home, cloud computing. So what had been expensive at the beginning of the year got even more expensive, and there certainly hasn't been any mean reversion for valuations on a year-to-date basis. And so as we transition from the market overview to our fund, I'll just spend a moment on slide 12, which is the investment philosophy for the International Opportunities Fund. And for us in managing this fund, it is a long-term approach. We think that so much of the rest of the market is way too short-term focused. We're looking out 3, 5, 7 years where not many others are looking, and trying to work out what's the true intrinsic value of a business based on its long-term growth prospects. We're looking for the steady compounders rather than the momentum growth or the real high-flying growth stocks. And that's because we do have a very strong valuation discipline. We also think that the market definitely overvalues companies that have very visible near-term growth prospects. But the flip side of that is we think that markets do tend to undervalue those steady compounders, the companies that can grow their earnings steadily in good environments and in more difficult market environments. And so our approach is all about trying to use a long-term view to identify those companies, buy them when they're at reasonable valuations, and hold them for the long term. And then as we move to slide 13, this just shows how that philosophy has worked over the long term. And this shows the performance of our fund versus the benchmark in different market environments. And that second group of bars there has been the most difficult market environments, when the market drops 5% or more in the course of a 3-month period. And you can see in terms of the frequency with which we've outperformed, very strong. And then that period is also, as you look at the average quarterly performance, that plus 1.61%, it's during those most difficult market environments that our relative performance has been strongest. And we think that really is a reflection of our focus on those high quality, very durable companies, which we're owning at reasonable valuations, because when there is fear and uncertainty in the markets, investors tend to flock towards the safety of the companies with the very strong management teams, the durable business models, the very healthy balance sheets. And those are the types of companies we own at all times, not just in difficult times. Then moving over to that next group of bars, when the market's been between -5 and +5, you'll notice this is by far the most frequent market environment. We would just consider this a more normal market environment. You can see there too a pretty compelling profile in terms of the frequency with which we've outperformed, as well as being able to add 30 basis points on average over the long term during those more normal market environments. So it's not just a defensive approach that does well in difficult market environments. It's a high quality approach that also delivers relative performance for our clients in more normal market environments. And then you can see to the far right on this page, the one market environment that has been certainly less ideal for our approach is when the market's rising rapidly in a short amount of time. Often those markets are characterized by less of a focus on fundamentals and more of a risk-on appetite. And you can see the fund that has been the one market environment that has been less favorable for our approach. As we move on to the next slide, this is just an overview of the investment process. It's a straightforward process designed to get us to about 70 high-quality growth stocks with reasonable valuations and those durable business models. And it starts with idea generation on the part of our analyst team. At any given time, there are approximately 1,000 international stocks that are rated buy, hold, or sell by our analyst team. And typically about 400 of those will be buy rated. And those serve as the starting point for our portfolio managers to narrow down to the roughly 70 that they're going to own in this fund. And they're doing that by looking for companies with above average growth prospects, companies with those high quality business models, and getting the valuation right. And so it results in a fund, when you roll it all together, it's a fund that is characterized by businesses with high quality traits like strong brands, high recurring revenue, and high customer switching costs. The fund has exposure to durable trends such as the growth of the emerging markets middle class and aging demographics across the developed world. And we build the portfolios with very much an emphasis on stock selection to drive relative performance. And then that process overall is supported by our risk management group. They're really involved at each step of the process is risk management. That group is continuously monitoring the portfolio to ensure we aren't taking any unintended bets. We don't want the macro factors to drive relative performance for the fund. We don't necessarily think we have an edge there. Instead, we want that bottom-up stock selection to determine the relative performance, because certainly we do have a lot of conviction in the ability of our analysts, and we show the analyst team on the next page. So here you can see the numbers and locations of our research analysts. We've built this big team up organically over the past 30 years with very much an emphasis on maintaining a collaborative culture because we need to ensure that analysts in different locations and on different sector teams are sharing critical information with each other in a timely manner. And I think one unique aspect of our research platform is the very tight integration between the equity and the credit analysts. Having them working closely together was a huge benefit during the crisis earlier this year. We had portfolio holdings with businesses tied to travel that all of a sudden were facing a shutdown of an undetermined length, and so it became critical to analyze their ability to service their debt. And so we were able to call on the expertise of our credit analysts for insight into which covenants might be waived, how reliant were companies on the commercial paper markets, and how likely were those to remain functioning in an orderly manner. What was the term structure of their debt and the likelihood companies would have to raise capital. So it seems like in periods of crisis, because we also saw this during the global financial crisis, that tight integration between equity and credit analysts really pays off for the benefit of our clients. And maybe just an example of how the collaboration on this platform works, just in more normal times. So going back several quarters ago before the crisis, we initiated a position in a Chinese online job recruitment company. And it was one of our analysts located in Hong Kong who's got primary coverage of that stock. And his work included discussions with colleagues that cover similar businesses in the US and Australia and Japan, as well as analysts that cover other online business verticals, including auto sales and real estate and food delivery. And it was through those discussions it really gave him confidence in this company's ability to expand revenue opportunities into adjacent areas like outsourced HR functions that could support continued revenue growth going forward for many years for that business. And then because the analyst who was covering this Chinese company was locally based in Hong Kong, he had his finger on the pulse for the potential political risks facing this company and thought it was very low versus a lot of the other Chinese internet stocks. We have been cautious of the risk of the Chinese government meddling with other very profitable internet companies for two reasons, really. One, to monitor citizens' online activity, and also to potentially direct investments in state-favored directions. Neither of those would be good for shareholders, but our analyst, in his assessment of this company, believed that the government was much less likely to interfere with this business because of the government's interest in supporting employment. Moving on to page 16, this gets into the year-to-date attribution. So it shows the drivers of returns in the first half of the year. This uses the growth benchmark, which certainly has been a much tougher benchmark to beat in this environment than any core benchmark. But certainly the theme of some of the more expensive stocks outperforming is reflected in this sector attribution. Most notably, you'll note that among the top detracting areas were consumer discretionary and information technology. And in consumer discretionary, not owning several of the Chinese internet stocks like JD.com and Pinduoduo, which are e-commerce plays, as well as Meituan Dianping, which is a food delivery company in Shanghai. Those were among the biggest detractors. We didn't own them due to concerns about valuation. And then a similar story in technology, where not owning Shopify, which has been the real all-star, I think, of this year, enabling a lot of bricks and mortars businesses that didn't previously have e-commerce capabilities to quickly build that out, and which was really essential to their survival. And then names like Keyence, which is a Japanese robotics and factory automation company. So the fact that we didn't own those were significant detractors during the first half of the year. And although we didn't own those, we certainly do own a handful of companies that are exposed to some of these great secular growth trends that really have been amplified in the current environment, with an emphasis on working from home and cloud communications. So within communication services, you can see we got a modest boost in stock selection there. That was tied to our positions in a couple of search engines, Naver out of South Korea and Yandex in Russia. Those are the dominant search engines in those countries. Those both are countries where regulations have made it very difficult for Google to operate profitably there. And then also in industrials, which you can see was the top contributing sector for the first half of the year, where we have an overweight position in Schneider Electric, which is benefiting from trends towards energy efficiency and industrial automation. As we move on to page 17 to take a look at some of the stock level contributors and detractors, and you can see it was led by Naver, that's the search engine in South Korea. They also recently formed a joint venture with SoftBank, which should bring a lot more clarity to the profitability of their chat business, which is a dominant player in the Japanese market. And then on the detractors side, you'll notice Rolls-Royce down pretty significantly during the first half of the year. Their primary business now is the manufacture of jet engines for wide-body airplanes. Obviously, a very hard-hit part of the market, given the COVID situation. And given the wide range of uncertainties, we've spent a lot of time looking at different scenarios based on assumptions for this business of how much air travel recovers, how quickly that happens, and then how much of the existing fleet of airplanes that are currently in service might get retired due to a drop-off in air travel. And that's really critical for Rolls-Royce because servicing engines is a key part of their revenue. And so how much of the fleet will remain in service coming out of this crisis is a key factor. And one thing we've taken comfort in is that Rolls-Royce has a relatively young fleet, so 43% of its wide-body fleet is less than 10 years old. So as airlines are likely going to be forced to retire older aircraft in response to lower demand, the servicing contracts that Rolls-Royce has in place, we think those should be somewhat insulated. So that is one that we are holding on to, despite certainly the near-term difficulty for that business. As we move on to page 18 with a quick look at transactions, and I might have expected that we'd have bought more after the markets crashed and valuations for a lot of things suddenly became a lot cheaper. But I think in large part, a lot of the opportunities, they just weren't there. Most of what got really cheap, we were wary of the balance sheet risks. And a good example is that we spent some time analyzing one of the stocks of a global hotel chain but after discussions with the fixed income team, just decided that their debt level was just too concerning if business travel didn't rebound to pre-crisis levels within the next couple of years. So we decided not to invest in that hotel chain. And then also the fact that markets bounced back so quickly that things certainly didn't stay cheap for long. I think a lot of what did stay relatively cheaper was areas like some of the European banks and some of the automakers, which just typically don't fit our high quality criteria. But you can see some of the moves we did make, a couple of new positions, Tencent, one of the big Chinese internet companies. We had long held off on buying that stock just because we thought a big portion of their revenue was tied to their gaming business, which we don't view as particularly high quality because it tends to be fairly hit driven, and the gamers can be pretty fickle in terms of there are low barriers to entry, and whenever a different company comes out with a hotter game, there's really nothing to prevent all the users from migrating over to a different platform. But what we've seen change with that business is now a very significant pathway for growth for their electronic payments business as well as their chat business. And as those have grown, the gaming portion of the business has become a lower portion of the revenue, which we view as a positive and do see long-term growth potential for e-payments, chat, as well as their cloud hosting business. And then Dassault Systems, French company, which is a leader in 3D CAD/CAM software solutions, and we think it's a business with a very strong competitive position, an excellent management team, and what we view as a long runway for growth, given their recent expansion into a number of different verticals that are new to that business. And then on the sales side, a couple of these reflect a little bit lower confidence in some of these businesses' long-term growth prospects. That certainly includes Fresenius and Baidu, as well as Toto. And then in the case of Taiwan Semiconductor, we certainly continue to like the company's long-term growth prospects, but the valuation had just gotten a little bit higher, as well as some concerns about potential loss of one of their larger clients over the next couple quarters. As we move on to portfolio positioning, and on slide 19, we show the portfolio on a sector basis. You'll note as you look up and down that under and overweight column, not very significant relative under and overweights. This is not a formal guideline, but the team does think about keeping the sectors roughly within plus or minus 5%. You can see a couple of those have modestly exceeded that now, but you wouldn't expect to see very dramatic differences in terms of the sector weightings, just because, again, we do want that stock selection to drive relative performance. But consumer staples is the top overweight. That, as well as healthcare, for many, many years have been overweights for this fund. And those are parts of the market where we find companies with strong brands, good pricing power, and very stable as opposed to very cyclical earnings streams. And so those are right in line with our high quality focus. Consumer discretionary, on the flip side, is the one notable underweight. That is due in large part to not owning the retailers and the automakers. We do have exposure to several luxury goods companies. You can see some of the names there. LVMH, the world's largest luxury goods company, Kering, which owns the Gucci brand, and we also own Burberry. And these companies, they don't have a substantial e-commerce presence to fall back on when bricks and mortar stores closed during the lockdowns. So it has been a tough environment for them on a year-to-date basis. But prior to this year, these have been generally strong performers for a couple of years, most notably LVMH and Kering. And a part of the reason that we have liked these businesses is because they are much less susceptible to disintermediation from e-commerce, and because when people are going to spend big sums of money on a new watch or handbag, they tend to want to make those purchases in person rather than do that online and run the risk of getting a counterfeit. On slide 21, which we'll jump ahead to, this shows the geographical exposure of the fund. And we show it here by domicile as well as by revenue. And we think where the revenues for a business are coming from are much more important. I think the most interesting line of this page is if you look across the emerging markets line, where you can see a sizable underweight by domicile. But by revenue, 34.8% of the fund's revenues are coming from the emerging markets. So that closes that underweight considerably. And certainly we're not managing this with any kind of a top-down view, but I think it's safe to say that we do like companies that have good exposure to the emerging markets middle class. We think that's going to continue to be an important growth engine for world economies and for companies going forward for many years to come. And so, as you can see, we have almost 54% of the fund invested in Europe ex-UK. But as you look on a revenue basis, and this is really the inverse of that emerging markets line, only about 16% of the revenue is coming from there. And so that's by virtue of owning companies like LVMH and Nestle and Diageo. These are companies headquartered in Europe, but getting very significant amounts of the revenue from that emerging markets middle-class consumer. As we move on to the next page, just to look at some of the portfolio stats, one number I would draw your attention to is just the number of holdings. And it's actually down to 65 now, which is at the low end of where we've been over the last several years. And that is just a function of, in this very uncertain environment, concentrating into slightly fewer names where we have greater level of certainty on the likely earnings growth for these businesses that we do own. We saw the same thing happen during the global financial crisis. And then as we move on to the next couple of pages, just to finish up with a couple of looks at performance, starting here with just the consistency of the outperformance, whether you're viewing it on a 1, 3, 5, or 7-year basis. And you can see those the average excess return that we've been able to deliver over those time periods as well. And then as we move on to the next page, this will show just the long-term performance drivers. I think I've mentioned a couple times how our goal is for stock selection to drive relative performance. So this is a 5-year attribution. And if you look down at that total line at the bottom, you can see the relative contribution. And keep in mind, this is based on cumulative rather than annualized numbers. But of that relative outperformance, about 16%, you can see 12.5 of that has been due to stock selection. So the vast amount of value add has been through that stock selection over the long term. And then just to finish up on the next page, so you can see the long-term performance. And you can see it's been very strong versus the MSCI EFA index. That is the official benchmark for this fund. And notice the difference here in that year-to-date period versus the returns we saw from the index on the attribution page. That attribution page uses the growth benchmark. We're comfortable managing to either. Certainly in this environment where this small handful of growth stocks has had such leadership in the market, the growth benchmark has been a tougher bogey But even when you look out over the longer term, whether you're looking versus the growth or the core benchmark, you can see a good amount of relative outperformance. And if you look year by year here too, again, you can see that consistency of the relative performance coming through. So I think we're right at about a half hour in. So I'd be happy to pause there and take any questions that may have come up.
Great, thank you very much, Pete. That was very clear, very precise, but very complete at the same time. So the first question we have is that since we've been seeing heightened tensions between the US and China, the US has increased restrictions and increased access to its markets to Chinese technology and microchip companies. So how concerned are you as to how this is going to translate to impact for the holdings in your fund, particularly tech and semiconductor companies?
Yeah, it's, we own one of the world's largest semiconductor chip makers, and so this is something we've been thinking a lot about. And I think any growth investor has to pay very close attention to what's going on in China. And this, I think it's gotten obviously the sort of the tension between the U.S. and China. Obviously, it's been in the headlines for years with the trade negotiations, but it feels like it's picked up in intensity more so even just in the last couple of weeks. And I think it's a really interesting from a geopolitical as well as a business strategy and investment perspective. And so the geopolitical aspect is certainly the U.S. is trying to bring tech supply lines out of China and limit the ability of Chinese companies to become ingrained as pivotal suppliers in technology. And that's due to security concerns. And we've seen this play out with the telecom companies and the build out of 5G, where the U.S. and a lot of countries in the West, frankly, have been concerned about China's ability to spy and sabotage if the Chinese telecom companies are key providers of the wireless communication networks in other countries. It's not just the U.S. The UK recently decided to ban Huawei from its 5G telecom network. Australia and Japan have done the same. And Singapore and Canada have recently awarded contracts to Nokia and Ericsson, which are our chief rivals to the Chinese Huawei. And so with regard to the chip makers, just last week, the U.S. banned Chinese companies from obtaining foreign-made chips that were produced using American technology, and that went into effect immediately. And I think what's interesting about it is most of the world's chips are actually manufactured in Asian countries like Taiwan and South Korea, but those Asian firms are relying very heavily on software and intellectual property and chip design and materials that are coming from the U.S. So as we think about it in terms of the impact on the semiconductor chip manufacturer that we do own in the fund, our analyst had noted going back a year ago that the Chinese companies were front-loading their chip purchases for 5G handsets and infrastructures out of fears that they might one day be blocked from doing so. And so now that's come to fruition, certainly the revenue stream for the chip makers is likely to go away. That's just one revenue stream for them. We had trimmed our semiconductor chip position recently, in part due to that concern, also just due to valuation. But overall, when we assess that, we think it's not a significant enough risk to that company to make us sell it. That company is a global leader in a growing industry. They earn 3 times the revenue of their closest competitor. They are by far the most profitable company in that industry. and they are highly diversified with over 450 customers. So certainly they are going to lose the revenue stream from some of their Chinese customers, but it's very well diversified. And so that's one we want to continue to hold on to. But that has been a fascinating dynamic to watch.
All right, the next question is about gold, which of course has done very well in 2020. So the question is, are the MFS analysts and portfolio managers incorporating or considering incorporating gold into their risk management strategy?
It's very topical because there have been a number of conversations across a lot of our sector team meetings and just within the portfolio management team for this fund about this very topic. And it stems from the concerns that the world has too much debt. It's recently added to that significantly as a response to the coronavirus crisis. And as you think about the potential ways out of that, it's unlikely that economies can grow their way out. Certainly, default would be is not even on the range of options. It would just be political suicide. So the best way is really to increase inflation. And so we've been asking from a portfolio and risk management perspective, what would happen to the portfolio in an inflationary environment? Because if thinking back over the last 20 to 30 years, it's really been characterized by low inflation and declining rates. But we've spent time talking about and thinking about, what would be rewarded if that were reversed. And certainly the companies that would do well in an inflationary environment, certainly the commodities companies, including gold and probably especially gold, because it is a great inflation hedge. And so it's certainly been under discussion, but we haven't done anything yet in this fund, but it's something that's certainly been talked about.
Okay, so keeping an eye on it. You mentioned in one of your charts the strong valuation discipline and patience in utilizing a contrarian approach. Can you provide us an example that would illustrate how this unfolds in selecting a holding?
Sure. So the team, they do maintain a watch list, and these are companies where they really like the growth fundamentals, but they just think the valuation's a little bit too rich. And so they will just try to be patient and continue to watch those stocks. And if there is a sell-off, either broadly across the market or just individually with a given company, they will be able to quickly, do the work to determine if, despite the recent sell-off, if that would be a good time to add the stock in. Maybe one example I mentioned as sort of a collaboration example, that Chinese job recruitment company, online job recruitment company, that was a name that we had followed for many years. We really liked the growth fundamentals, but we just thought it was too expensive. And then that was bought into this fund in late 2018, and at a point where the stock was down 40% from where it had begun the year. And a lot of that was due to concerns about what would the impact of the U.S.-China trade negotiations have on the job-seeking market in China. We certainly recognized that it would likely lead to a near-term slowdown in revenue for them. But with that long-term view, we didn't think that their earnings power was very much impacted at all. So we stepped in and bought it at that time. So it's often reflected in buying companies when something bad has just recently happened. But with our long-term view, if we think we have a differentiated view of their prospects going forward.
Okay. Also, in one of your charts, you mentioned that the fund has a focus on high-quality blue-chip companies. But how does the opportunity set in the small cap and mid cap space fit in when you see them for an international growth fund?
Yes, we are are certainly open to owning small and mid caps. I'd say especially mid caps. And actually, if you look at the fund now, we do have about 10% of the fund invested in mid caps. If you define that as companies with market cap below 10 billion US. And I know that blue chip, I think that carries this connotation that they tend to be large companies. But we believe blue chips can be small and mid caps if they do have dominant market positions. And so if you look at what we do own in that mid cap level, they tend to be businesses that operate in a single country. And I guess that includes several financial services companies. So we've got a consumer financial services company in Japan, and then we own a couple of banks in the Czech Republic, in Mexico, and Peru. And due to regulations, most banks, especially in emerging markets, operate in just one country. But we do like the emerging markets banks because, especially compared to the global opportunity set outside of North America, we think they have much better growth prospects than the banks in developed Europe and in Japan, in both places where you've got interest rates that are so low that it just makes it very difficult for the banks to generate much in the way of net interest margin. And you also, in emerging markets, these banks, it's not like in the developed world, if you think about the banking market in Canada or in the US, tends to be maybe overbanked, just a lot of strong competitors competing fiercely for customers' businesses. In the emerging markets, those markets tend to be characterized by one or two dominant banks, and that just allows them to operate a little bit more profitably.
Okay, great, thanks. Questions came in around the North American holdings in an international fund, like for example, 5.5% domiciled in North America and much more than that revenue coming from North America. So when you discuss the title like Shopify, some of our participants on the line were surprised that that would be considered for an international mandate. So I wonder if you could comment on that.
Sure. And just to clarify, I mentioned Shopify. It's not a company we have owned in this fund. And in fact, we don't have any direct Canadian exposure in this fund. So what shows up in North America there, it's three stocks. One is Linde, which is an industrial gas company, had been headquartered in Germany for many, many years, just recently did a merger with a US company and changed its incorporation to the US, but still has a huge business in Europe and outside the US. And then the other two, so Accenture is one of the others. That company, their headquarters is officially in Ireland. I think we all know that's for tax avoidance purposes, but it's listed, primary listing is on the US exchange, and so that shows up in our materials as a US company. And then Mettler Toledo, which is a company that has, they sell a lot of weights and scales and measurement instruments, which are used across a variety of both medical and industrial applications. And that business is more than half outside of North America. So we will own a small number of North American names as long as they do generate the majority of their revenues from outside of North America. And then there are a couple of sort of unique situations like Linde and like Accenture, which probably should be classified overseas, but nonetheless fall into the US category in our systems.
Okay, and about Alibaba, I'm wondering if you could just give us a little bit more on your rationale behind moves towards that company.
Mm-hmm. So it's a name. It's interesting. We had owned it We sold it earlier this year, and then it was bought back into the fund. And that kind of came after sort of stepping back and taking a look at our exposure to companies that I've talked about a couple times, companies that have exposure to these great secular growth trends that have seen a lot of demand pulled forward. And in China, Tencent and Alibaba are really the two dominant cloud companies. Alibaba, obviously, the e-commerce leader in China as well. So just based on their exposure to those two very attractive long-term growth businesses, that is a name that we wanted to add back into the fund.
Okay, great. And also a question on the underweight in energy. The comment was at these prices, would it not potentially be an opportunity to be wading back in to energy?
Yeah, and so energy, when we do invest in companies in the energy sector, it's never based on any kind of a prediction of where we think the price of oil is heading. We want to own companies that we think can grow revenues from cycle to cycle. And so it's not about trying to buy when oil's low and sell when oil's high. It's much more of a focus on a company's long-term growth potential. And energy, it is a very small part of the growth benchmark. If you just flipping over to that page, I think it's page 19, that shows the energy exposure. So it's only 1.1% of our benchmark. We have just the one holding there, Oil Search. So I guess I would just summarize it by saying we don't find many opportunities there for companies that we think can grow across cycle in a profitable way.
Okay. The last question I've got is relating to real estate here in Canada, and also from the business stuff that I watch about the US. Residential real estate, particularly just outside of the city, now that people can telecommute, seems to be doing really well. But there's great concern, of course, about commercial real estate, because are we ever going to end up back in, and at what capacity? So how does that translate to the international market? Because we're less exposed to how that would look, in Europe and in emerging markets.
Yeah, I think broadly, I think you would expect to see those same sorts of trends where maybe not quite as pronounced. I think in the U.S. in particular, where there's been a lot of unrest in cities, you're not really seeing that to the same extent elsewhere. But certainly with everyone now sort of proving that working from home can work and be very effective, and I think people are thinking there's less of a need to be within close commuting distance or to be right in the city center and very close to where they're working. So I think that you will see that trend play out overseas as well. That area, real estate, again, is it's just 1.7% of our benchmark, and we haven't had direct exposure to any of the REITs that are in the benchmark in this fund. And again, it just is just tied towards trying to find companies that have real differentiated products and services and good cross-cycle growth prospects.
Okay, great. Well, I think we've covered all of the questions that have come in. So Peter, I'd really like to thank you for your time today. We appreciate you walking us through the Sun Life MFS International Opportunities Fund, and more specifically outlining your current positioning as it relates to opportunities. I'm going to say again, it was so clear It's great when portfolio managers speak in a way that's really easy for us to understand and then communicate directly to our clients, the investors who are asking these questions, because of everything that they're watching in the news. So thank you very much. It was great. Really enjoyed it. To all of our participants who joined in today, well over 300, on behalf of SLGI, we really want to thank you for your interest in this call and also your support of SLGI in general. If you'd like to learn more about Sun Life MFS funds, please visit our website in two places. Under the Insights section, you can find recent articles written by MFS, plus our sales aids and support materials for the MFS funds. And also under the product section of our website, you can find the detailed fact sheets on the Sun Life MFS funds. So in closing, I'd just like to say that our team here at SLGI is very grateful for your continued support, and we are steadfast in our commitment to support you and your clients in these extraordinary times. We are here to help you and your clients navigate these uncharted waters, and they sure are uncharted. So please contact your SLGI Wealth sales teams to look at all the ways that we can be of assistance to you in your interactions with your clients. So once again, thank you. And very importantly, please stay healthy, please stay safe, and remain vigilant and proactive with your clients. And I wish everybody a tremendous last few weeks of this summer of 2020, this so unique summer. Thank you very much again to Pete and to all of our participants. Thank you. Have a great rest of the day.